Hi, good day everyone. So before we proceed, let me introduce first myself. I'm Marina J. Uy from BSBA, major in Financial Management. So the first question is, as an investment advisor, what are you going to offer to the investor? So before we proceed that question, let us know what is investment advisor. Investment advisor are financial experts who make investment decisions or perform security research in return for a commission. Investment advisor work as financial market practitioner by providing advice to investors in return for unique commissions. Investment advisors owe a fiduciary obligation or fiduciary duty to their clients and are always obliged to position the needs of their clients first. So, what is fiduciary obligation or fiduciary duty? A fiduciary responsibility occurs in law when an individual or entity respects, trusts, and relies on another person to exercise discretion or professionalism in working on behalf of the client. The trustee must knowingly acknowledge the confidence and trust. Financial professionals that make investment recommendation or conduct security analysis in exchange for a fee. So let's proceed to the next question. As an investment advisor, you will use a number of different investment styles and strategies such as growth or values. To give good advice, an investment advisor must gather personal and financial data about the client. You must understand the client's tolerance for risk and their expected rate of return on investment. A good investment advisor will use this data to analyze existing investments and make recommendations about what the client should do going forward. There are different styles and strategies that vary tremendously. True advisors should always offer a clear, easy to understand description of their basic money management approach. Explain why real choices should be preferred or not. So, financial advisors know more about savings and handling capital than other people do. So, financial advisor will make recommendation at the right ways to boost the finances. This will cover anything from what kind of savings to what kind of insurance to buy. They will help you in making better decisions than you can make on your own. So let's proceed to the next question. The third question is, how about the timing options? So often, an investor has a choice to start a project immediately to wait and make decision at some time in the future. So an investment potential with a positive net profit value does not mean that we can go forward today. In fact, if we can delay the investment decision, we can wait. The optimum timing is the trade-off between current cash flow and future cash flow. The timing option offers an incentive to spend when the conditions are more desirable. However, the timing option also offers the manager an opportunity to manipulate the timing of the investment in situations in which it is further lagging behind. So let's proceed to the fourth question. The fourth question is, if so, clarify the capital investment structure to the investor. Within the board categories, the structure of the deal depends on your business viability. Certain investment mechanisms allow you to invest in markets that would otherwise not be feasible due to the scale of the minimum investment. The investment structure refers how your investment has been legally owned. Legal organization can be individuals, partnerships, corporations, or trust. The arrangement of your investment contract relies on a lot of different variables. First, there are three forms of investor financing: interest or debt, equity, and convertible debt. The investing process offers a framework that helps investors to see the origins behind to the number of investment techniques and philosophies. Through doing so, it encourages investors to allow the hundreds of strategies described in the popular press and investing newsletter and to map them to their common roots. So let's proceed to the next question. The fifth question is that explain the pros and cons of their dividends as well. So the first pros is that installation from the stock market. One of the many advantages of investing based on dividends is the installation from the stock market. They do not have the same ease of liquidity in their stock purchases. The stock price can hardly be forecast with much precision. Stocks fluctuate on the basis of the poor demands of investors and of the actions of massive hedge funds and other big firms. The average investor does not have the same technology and access to information that many institutional investors have and is at a disadvantage in these guessing games as well. An investor may have to pay a few dollars or even pesos every time they buy or sell, cutting deeply into any returns that they hope to receive from buying low and selling high. The second pros is compounding. Reinvesting your dividends earning, you can grow both your number of shares and the dividends per share. The price of the stock increasing are not inconsequential here. You will get a competitive return regardless of what happens with the stock price. You can use your dividends earnings to generate even more earnings. This process is referred to as compounding. So the third pros is dividends can provide a reliable income stream. The compounding effect is most clearly displayed in the rule. This rule states that a person can take the percentage of their dividends, divide by 8, and the result is the number of years that it will take a person initial investment to double. Dividends can provide a reliable income stream similar to other forms of investing such as real estate or bonds. A dividend investor can use the reliability of dividends to pursue portfolio growth in a different way than the traditional stock market. The first con is eventual cap on return. One downside to investing in stock for the dividends is an eventual cap on returns. The dividend stock may pay out a sizable rate of return, but even the most high-yield stock do not pay more than 10% per quarter. A high-growth stock strategy could lead to massive losses, but the ceiling on the gains is much higher. Even if a company has the highest dividends manageable, they still will not have the kind of yield that most growth investing approaches will have, along with all the other risks of principal that stock investing may have. The second cons is that double taxation. The first time tax is paid on the dividends is before you even receive the dividends. The second tax is that has to be paid by you, the investor, as a personal income tax on your dividends earnings over the course of a year. Earnings from dividends investments will be taxed not once but twice. The third cons is high rates. Dividend payments can also be deceptively high and can lead to portfolio challenges as a result of the deception. Since yield is a fraction dependent on both dividends and price, a dividend may seem incredibly high even though it is about to be cut the next time an investor is eligible for a dividend payment. An investor must do his homework in order to figure out the true nature of a company's stock yield. Investing in dividends should not be approached which is investor proceed with lightly. This approach requires a considerable amount of time and research, and similar risks are applicable as with all the other forms in investing. But knowingly about the positive and negative of dividends investing is a good first step to figure out if this uh, popular growing approach to investing is right for you. So, let's proceed to the next question, or the last question. Cite the facts and the estimation to the investors. So first is that protection comes before investing. So the easiest way to handle investing risk is to cover yourself emotionally. When things go south, many who have traded in the stock market for the past 2 years know full when the party or the parties doesn't last long. All investments carry a level of risk. Most people try to avoid the risk by going the products with guaranteed returns, which more often are scams. So the second is you need to have a financial goal. This means that your financial goals will dictate where you should invest. So the third is that you cannot just copy how other people invest. My financial goals are not the same as yours, which means you cannot just invest where I invest. Investing is a personal task. People invest for different reasons. So the fourth one is that never invest in something that you don't understand. There's a lot of misinformation out there when it comes to personal finance. Most of them feeding on the fear or the greed of a person just to convince them to put their hard earned money to their investment. I've seen too many people getting fooled into investing on something just after being presented with some made up, satisfy and fake testimonials. It's unbelievable how these snakes marketing strategies still work. The estimated earnings are the project potential earnings per share of the organization as estimated by competent analysis. Investors use profit estimate to forecast the company's growth prospect and to make trading decisions. But you should be wiser now. Remember that ignorance is expensive. That's why knowledge is and will always be the best investment. Learn more, keep learnings, learn for life, and you will never be poor. Investors rely on the earnings estimate to analyze the stock of a firm and to make buy or sell decision. Consensus earnings estimate are used as a standard to evaluate a firm performance. That would be all. Thank you.